This is the financial intelligence session, and we have Mr. John Haskell here. So take it away.
Thanks. Awesome. Everybody wanted to come and talk about finance. This is good. The last presentation was really fantastic, so I am glad to follow that up. All right, can you hear me, or do I need to use the mic? You're in the back, so is anybody deafer than she is? Can you hear? All right, if you can't hear me, please let me know, I'll speak up. All right, so we're going to talk about a couple of different things. It's going to wander around a little bit. And I want to make sure we start with kind of an end in mind. I own a company that we work entirely with farmers and ranchers. We're mostly livestock focused. So that's when I talk, I often speak with that bias. We also work with, straight farmers, but that's not the majority of our client base. Our whole goal of our company, we're focused on bookkeeping and accounting, but the whole purpose of our company is to make agricultural businesses more successful. So we don't have an interest in bookkeeping as an example for bookkeeping's sake. We are only interested in doing it to the degree that it makes people more successful in their business. There are a lot of parts of running an agricultural business of any kind or size that have to do with, social factors and environmental factors and financial factors. So we address one very specific segment, which is the financial factor. I believe that managing the finances correctly of any business is kind of like breathing. There are people that say that they own a business to make money. I don't agree that that's correct. Making money is what you do so that you can keep running the business. You don't get to sort of live your life without breathing, and you don't get to run a business without, income and expenses. That's just part of the deal. We work in an industry that is almost entirely, let me back up. We work in an industry that has huge advantages relative to other industries. If I am a microwave salesman, microwaves don't just reproduce, and they don't increase in size and in value over time. Agricultural businesses have the opportunity to take costs and to take inventory and manage that inventory in such a way so that it either reproduces itself or increases in value. So think of a steer that starts at 300 pounds and grows to 1,300 pounds. There's a change in value there. Or I take a kernel of corn and I put it in the ground and it yields, 18,000 additional kernels. Not entirely by itself, but largely self-directed. Does that make sense? When we talk about agriculture, let me see what when we talk about agriculture, almost everyone knows that there is no money to be made in agriculture. And I'm going to just tell you right off, I 100% disagree with that statement, with that philosophy, with that cultural paradigm, with those people that say that. I hear this all the time. This is what we repeat to ourselves. This is what our parents tell us when we are young. This is what my parents still tell me, which is important. And I have to think in a way that is entirely different from that. Again, we're going to be very financially focused, so I realize there are other parts of the business that impact the outcome, but I believe that starting with the positive sort of mental framework or the overall psychology that we have the ability to do very well in this industry, and in order for that to happen, we take the normal steps that we would take in order to do well at anything, right? We have to know some stuff, we have to have some knowledge, we have to do some monitoring, and we have to make adjustments. And those are sort of common processes to all things, right? So when I talk about this, I want to make very certain that we all understand that the way you think about financial things matters. The way you think about your business matters. I was at a meeting recently where a man used a wonderful example. They were struggling in a pretty large Kansas farm. They're, Schedule F filers. They do everything under their name. Him and his wife. It wasn't necessarily a business, right? It was just them. And when they started a real change process in their business, they didn't necessarily create an entity, but they created a name for the business that was separate from them. And there are some real simple things relating to your identity, or our identity and our business that I think it's important to begin to separate a little bit. You know, growing up in this business as a young person, my identity was cowboy, right? Rancher, like, you know, however you want to, stockman, however you want to call yourself. I took a very severe injury for me in about 4 months in bed to realize that I had a problem. My job or my vocation or my business could not be my identity. Does that make sense? Okay, there's a point where we have to separate from that. And I don't mean that in any kind of bad way. I love what I do. I love what most of you do. I like doing it. It is something that I do for fun as well as for profit. But there has to be a line. There has to be some point where I understand that if I can't continue doing what I love, I still have an identity separate from that. Does that make sense? Okay, so sometimes it's as simple as creating some of those boundaries. I think I've talked about you have to know that you can be profitable, that is possible. I'm not going to tell you that you can be profitable in any situation or that any agricultural business is going to be profitable at the same level. But if you start without ever putting that on the table, you have started from a huge disadvantage. And you also have to understand that the clients that we have that work for us have to embrace, whether consciously or subconsciously, the belief that by knowing your numbers, by understanding your financials, and by digging into them, you have the power to make them better. And I think that's a very important thing that most people gloss over. We are often victims of, this winter we've been a victim of the weather. Last summer we were a victim of the weather. We're often victims of markets. We're, subject to all of these things. My father loves to say that, Mother Nature is a really crappy business partner. That may be. We've chosen her as the partner, so we have to proceed with that in mind. Does that make sense? Okay. So we try very hard to stay out of the, well, this happened and so therefore. Well, we're the driver of this thing. Doesn't mean that we control all of the variables. What it means is that we're responsible for responding to those variables in an appropriate and effective way. And one thing that I see a lot is people get in financial trouble. Well, the first thing they stop doing is looking at their finances, right? Why? Well, because they suck. Right? We've all been there. Who wants to look at that again? Like, I don't want to really check my bank balance because I don't really, what's the balance on my line of credit? I feel better not knowing. It's a terrible response, right? This is one of those, like, do the hard thing first, like, look at your line of credit balance first thing in the morning, not at the end of the day, right? Knowing where you stand gives you power to be an active agent, okay? And that's a very, very important concept. Most of us do not have the background and the training and the education that we need to be really effective in our financials. Most of us are really overwhelmed by it. Most of us do not have a good mentor in this area. Most of us, even if we've received training, our training has been kind of crappy. Our system, frankly, is set up to be so simple that a fifth grader can run it, and a fifth grader can understand the implications of the outcome. And that part is... That's actually kind of the hard part to get to, right? It's easy to work with a CPA who will give you reams of paper back every month about what's going on. It's a lot harder to sort of synthesize that and turn it into something actionable. And that we're going to talk more about that as we go. Yeah, and then this bottom one, this is funny to most people, but it's not wrong. And I'll argue this all day long, but most of the things that you worry about, most of your, sort of worst case scenarios in the future, most of the really bad things we think about are completely unwarranted, right? They're just not true. We all can imagine worst case scenarios. Most of us have a better imagination. Our imagination is more exciting than reality, right? And usually that's not the case. Usually reality is somewhere fairly reasonable. All right, questions before we go on? And just for this, if you have a question as we go, please don't save it till the end. I'd rather you interrupted me, and we'll adjust as we go. Questions, comments, thoughts? Okay, you're either sleeping or not interested. I will proceed as such. All right, the last presentation we talked about was fascinating to me because I've asked for years about what is the, what are the dangers of selling custom exempt meat, you know, and it just seems to me like this is a place where we're creating regulations to solve a problem that doesn't exist. I love it. It's like government's answer for everything. Like, we will solve a problem that isn't even a problem yet, you know? Or if we're gonna solve a problem, I was just at the airport the other day, I'm still taking off my shoes because a stupid guy named Richard Reed, you know, put a bomb in his shoes. Somehow, like, I don't know how long that's been. Has that been, you know, 15 years ago that happened? We're still taking off our shoes? Like, terrorist would be stupid to do that again. Like, it's already been done. It's not the shoes, now it's gonna be the next thing, right? We never have enough imagination for that as a government never does. The great thing about our society is that we claim to embrace the idea of a free market and entrepreneurship and innovation. And one of the things that's a lot of fun to watch in the wider world is the fact that serving customers becomes an incredible way to build wealth, by us creating value, and whether you want to call it solving the problems of other people or creating value for other people, that is the fundamental way in our business, that is the fundamental opportunity we have to create income for ourselves. Most people in agriculture, in my mind, are far too focused on what they want to do. And that's a bit of an entitlement mentality that I don't appreciate. If you want to grow, you know, X because that's what you love, it's great. You can do that. That's a wonderful hobby. If you like building model airplanes, you're welcome to do that in your spare time. If you like taking pictures of sunsets, you're welcome to do that. It's a crappy basis for a business. A business really is about serving customers. Ultimately, that business also serves the owner, right? But creating customer value is where things are at. And we see this in markets all the time where, maybe I'm skipping ahead of myself. I'm going to skip down to the bottom, but where price often tells us what customers value, right? Something might be more expensive or less expensive because that's what the customer puts more value on, right? Oftentimes customers are surveyed and they answer questions. And what I learned in college when I learned more about that was that customers often answer questions differently than the way they spend their money. And what we ultimately need to get back to if we are running a business that relies on them spending money is what do they actually spend their money on? So you can tell me all of your wonderful ideas about how you want to do this, that, and the other thing. Ultimately, the person at the grocery store is standing in front of a wall of choices. They make an actual choice. They don't make a theoretical choice at that point. My job is to live as much in reality as I can, okay, and deal with what is, not with what should be. Does that make sense? Okay, so then that comes to this middle block, which is we should sell, what we sell should capture the value that we create. Okay, so whether we grow cucumbers or whether we grow calves or whether we grow lambs, whether we grow bred cows or bred ewes, our marketing, if you will, decisions about what to buy and sell and when should be very focused on that customer value that we are creating. Does that make sense? Okay. Value is a wonderful thing because it's very individual. What you value and what I value are probably very different. What I would pay for a new Mercedes-Benz is clearly very different from what people that actually buy Mercedes-Benzes would pay, right? That would be worth like 50 bucks to me. There are people who want to pay 50,000 for that opportunity. On the other hand, a pickup is pretty valuable in my world. I might pay more than the Mercedes customer would pay. Ultimately, that value is subjective and it is individual. There are no real bounds on it. A lot of it has to do with just finding the right pairing of people. The other fun thing is every transaction that goes forward, if we think about win-win transactions in a marketplace, we are often talking about asymmetries where I feel like I'm getting a good deal and you feel like you're getting a good deal. And so matching those places up where the value of something, the value of one product between two parties, the vendor and the customer, the value is different to each of them. Does that make sense? So we're continually trying to set up situations where something I want to sell and I feel like I'm getting a good price is priced such that you feel like you're getting a good deal. Does that make sense? I'm getting a good deal for selling it, you're getting a good deal for buying it from our own perspective, right? Some third party may look at it and think that's a completely ludicrous transaction. Doesn't matter. He's the one with the money, I'm the one with the product. We're the two that have to interact. Does that make sense? Okay, questions about this before we go on? It's a little theoretical background. We're gonna get into a little more financial stuff, but.
On your customer value,
Yes.
like how, and when you're kind of in a commercial market, like, you know, the cattle market, how do you, like, we're trying to go direct to consumer now.
Yep.
Instead of, well, direct to, we're selling replacement heifers.
Sure, up.
So doing that, in terms of your other stuff, like your steers, what do you do with that in terms of creating value?
Great
You know?
question. Okay. So did everybody hear her question? No. Okay. She's asking, can I paraphrase just a little? Tell me if I get it wrong.
No,
In a commodity world, how do I differentiate different value?
Yeah.
Is that fair? Okay. So take cattle as an example, right? Cattle are traded out in the open. Everybody knows what the price is. 5-weight calves are worth this, 6-weight calves are worth that. A bred heifer that's 2 months away from calving is worth that. A 4-year-old cow is that. Okay. Essentially, we have to come up with a system, and this is something we work a lot in, that shows how that price at the market is different from the value at your house. Okay? So the value at your house is often determined by your cost. Does that make sense? So it costs me $500 to get a 550-pound heifer pregnant and to the point where she's about to calve. Is that fair? Okay. So knowing that number, I can go look at the market and see if the market will actually pay me $500 to get from point A to point B. Does that make sense?
Yeah.
So a number I use a lot. We do a lot of comparisons within the livestock market. Livestock are great because there's this whole spectrum of weight. There are different slices of, you know, gender, right? Heifer and steer, or bull and, you know, cow. And then there are different, you know, I mean, they're all, breeds, classes, grades. I mean, there's this like infinite world. And in all of those, you can come up with real price comparisons because we have a wonderful system of price transparency, right? When animals are sold in public, that is often written down by somebody, and right now you can get it on the web, right? So I can look at prices in West Virginia, I can look at prices in California, I can look at prices in Wyoming. Does that make sense? Okay, so a number I use in that case is I know I can sell a bred heifer right now for $1,500. I'm pulling numbers out of the air, these aren't exactly current. I know that I can buy a 550-pound heifer right now for about $1,100. The difference is $400. That tells me I shouldn't be selling a replacement heifer. Does that make sense? Because I can buy the replacement heifer cheaper than I can make her. Does that make sense? Now there are, if we go to a slightly different market where we see that we can sell a bred heifer for $2,000 and I can buy one for $1,100, then I can make $900 on something that cost me $500. That's probably something I'm going to look seriously at.
Yeah.
Does that make sense?
Yep.
Okay, when you look through the prices of calves, as an example, just take steer calves ranging from 800 pounds down to 300 pounds, you can create a comparison that shows you what do you get paid for each additional 100 pounds of gain, okay? There's a guy, a good friend of mine that teaches this. He refers to it as sell-by marketing. His name is Wally Olson. And he has done, he following up on work that a guy named Bud Williams did, has done a wonderful job of showing us how to find where the value of gain is. Does that make sense? Okay, so he and I partner on a lot of stuff. Right now we are buying 5-weight heifers for about $1,100, and we're contracting them for August delivery for about $1,700, $1,800.
Yeah.
I'll do that trade all day long. Costs us $100 for the summer to graze them. We're good. Does that make sense? What we often do, and let me give you the counter example, is often we say, okay, I calve in March and I wean in November, and that's when I sell. If you do that over and over and over again, you're doing what you want to do.
Yeah.
Right? You're not looking at the market to see how what the market says you should do.
Yeah.
A lot of the time in the fall, particularly in our part of the world, when almost everyone sells their calves, right, between the 1st of October and about the 1st of December, right? It's about a 60-day period, a huge number of calves come. The one thing we know about supply and demand is that when there is a big supply, relative to the demand, the price goes down. Okay, so when's the cheapest time to buy a 5-weight calf? It's like the 20th of October.
Yeah.
Does that make sense? Okay, so if I continue doing that and I'm not happy with the price, that's on me. Does that make sense? I'm choosing to sell into the lowest market of the year. Now, the way most people solve that is they go to like a direct-to-consumer thing, right? We're gonna add all this value. I look at a lot of direct-to-consumer businesses that are not that profitable. And the biggest reason is because it's like a tag-on to a ranch, right? We have a ranch, we're good at ranching. Now we've heard that you can make a lot of money selling direct-to-consumer. We kind of add that on as an afterthought. It's not really your wheelhouse. It adds a bunch of other skills. There's a whole bunch of other stuff that goes with it, and it doesn't go that well, right? Now, I work with people also that literally they do direct-to-consumer. Like that's their business. You know, they might do $1 million in sales a year, or 600,000 in sales a year, but that's the business that they do. They're very good at it. They understand dealing with customers. They understand distribution, all those sorts of things. It's a very different business. The way I recommend real, straight up livestock producers increase their margin is by marketing, not by, and when we use marketing in this world, we're talking, it's a term that kind of comes out of the feedlot world, which is what to buy and when, and what to sell and when. It's not glossy, what I call horse marketing, right? Glossy ads with, horses running through green pastures in Ohio, right? It's what to buy and when, and what to sell and when. Using those decisions, we can find out that same 500-pound calf that I sold for $900 in October, this year as an example, is now worth $1,200. Does that make sense? So I can add $300 in gross income. I'm going to have some costs that come with that, right? And we've been blessed with costs this winter. Is that a good trade?
Yeah.
Does that make sense?
Yeah.
Okay. Does that answer your question?
Yes.
Okay, so there are a tremendous number of options even just within the world of commodity trading by adjusting our time and by adjusting what our product is that we can create huge increases in value. Again, I think most of you folks are, just out of curiosity, how many of you do some kind of direct-to-consumer? Okay, well, not as many as I thought. I thought that was most of you. Good. In the world that I look at, the most profitable businesses don't get out of their area. They don't get out of their lane. So if they're direct-to-consumer businesses, they're direct-to-consumer businesses. If they're ranches, for example, they ranch. And they ranch really well, and they generate the biggest profits that I see. By far. Like, it's not even close. The direct-to-consumer thing is good if you do it well. But the highest returns I see there are usually doubled by the highest returns I see in just straight-up commodity agriculture. That said, the highest returns we see do not resemble the average. Okay, so there's a huge disconnect between the average commodity producer, which is generally crap financially. And I mean no insult to anyone, but it's a poor return. We all know that. We work very hard. We don't do that well at it. But the folks that do that well, it's like you're on a different universe, right? You're not even, it's not the same world. Does that make sense? All right, very good. More questions on that? Follow up?
I'm good, yeah.
Okay, all right, great. Anybody else add on to that? So just out of curiosity, what do the rest of you that don't do direct-to-consumer do? Just,
I'm here learning, looking for possibly profitable operations.
Cool.
I have a marketing background. This is marketing.
okay, good. You're the glossy pictures marketing.
I've done some of that.
Yeah.
But I work for a defense contract. I've done a lot of different things in my life. So
Cool.
yeah, I'm looking to learn and possibly explore opportunities.
Very good. Anybody else care to volunteer what they do? No? Okay, that works.
Well, I'll tell you, so ironically, I did not know when I walked in here what you did. I am a bookkeeper actually.
Cool.
Personally, but we are working on a ranch who is just starting to do direct to consumer, trying to diversify whatever. But since we don't own the ranch, we're only working the ranch, there's a lot of complications and communications and just how to make it work the best. So.
Awesome, good. Well, I'm going to give you hopefully some resources to help you with your bookkeeping. So let's see how that goes. If you're looking for a job, we're hiring bookkeepers. All right, so then this is a little bit of a repeat of what we've been talking about, but whatever business you are in, your strategy matters. And you have to choose. Most people try not to choose. They try to do a little bit of everything, and when you're starting out, maybe that's okay. You're in the, what we call the anything for a buck business. You can come up with the acronym for that, but that's one world. But generally, I'm a big believer that being specific and becoming an expert in your area is the way to success. Niches make riches is one of my favorite sayings. If you do something, do it well. Diversification is for people that don't know what to do, right? If you're gonna put all your eggs in one basket, you guard it with a machine gun and you guard it with your life, right? So do know your business and know it very well. And this requires a lot of knowing yourself. Again, I mentioned that people that do sort of direct consumer as an add-on to a ranch business, most of those people are not acknowledging the fundamental truth, which is they don't really want to go to farmers markets. They really don't want to, you know, again, the stuff it sounds like you're dealing with, they don't want to do that, right? So don't do it, because it's probably not going to go well. If that's something you like to do, then do it, double down on it, right? Do a bunch of it. All right, the other thing that comes up when we talk about financials, particularly in livestock and crop enterprises, is the fact that inventory is a huge part of your business. Take the livestock business as an example. Changes in your inventory value can absolutely dwarf your average cash flow. Does everybody remember a couple of years ago when cattle prices dropped like 50 to 70%? Okay, we had a wonderful summer where we sold calves for fall delivery for $1,600 a head. We had a great time at the Sail and Steamboat. That was the best party I think I've ever been to. It was fantastic. The next year we were looking at heifer prices that were like, I was able to buy heifers for $580 a piece, right? It was a big swing. Did you have your hand up? No, okay. But you remember that, huh?
Yes.
Yeah, okay. So that change in my inventory value alone, which is not a cash transaction necessarily, right? But that change in inventory value had a huge impact on my business and on everyone else's, right? When I think wheat prices fell 70%, shortly before that, I think it was a year before, right, when wheat prices really crashed out. That change is big and it's important and it's something we need to be paying attention to. Now you say, well, it doesn't have a cash impact, so what does it matter? That's very incorrect, and we can talk in great detail about why that is, but we're just going to leave it at that for right now, if that's okay. When we have an inventory, and the three main components, of course, in a livestock business, it's similar in a farm business, but they are the livestock we have, the grass or the feed that we have, and the money that we have. And our job as inventory managers or asset managers is to balance those three things so that we can continue to operate. We also have time. Time is a very important thing, and we'll talk about this in two ways. First way to think about time is strictly human resources, right? I have so many hours in the day that are light that I can get things done in. I try not to do things in the dark. But the other thing that we have that is inherent with livestock and with crops is all of those things have some sort of expiration date in them, and they have some lags in them. So if I plant a corn crop, there's this point where I have no value in that crop until it gets to a certain point, right? So how valuable is a half-grown corn crop? Let's say in Wyoming it cost me $650 to establish that crop, get it up to 12 inches tall. What's the value of it? I'm gonna go harvest it now. It's 12 inches tall. What's the value? Yeah, it is literally zero, right? Probably less than zero because it's gonna cost me more to actually cut that than there's gonna be in, if I were to cut it and bale it at 18 inches. Like what would I mean, ridiculous, right? Same, we have this period like with pears where you can sell a pear. It's a pretty valuable thing, right? Cow is heavy bred, she's got some value. A cow that's got a small calf by her side, she's pretty valuable. And then there's this like no man's land where nobody really wants to buy a cow with a 250 to 300 pound calf the 1st of July, right? If you try to go sell those, there just isn't a market for, like, everybody's cutting hay and irrigating and doing other stuff. There's like no liquidity there, right? So you have these problems of dead spots, and then again with the corn crop, eventually it gets to a point where boom, it's ready to harvest. Well, what happens 3 months after that if you don't get it harvested?
It's toast.
Yeah, then it looks like that outside, and you're screwed, right? Now it's worth even less because you've screwed up next year's planting, right? If I have a 1,300 pound steer in a feed yard and COVID hits and I can't get her or him out of the feed yard, what happens?
It's not worth it.
Right, his value is actually declining, right? Because now he's getting over fat, and I'm getting a daily feed bill. And the feed bill isn't going down, right? The feed bill, nobody cares about the fact that my steer is worth less a month later than he is, earlier. But on, March 10th of 2020, that steer was worth pretty good money. And about April 10th, trying to just get somebody to take him away was a problem, right? We've seen this a number of times in the pork and chicken business. COVID was a good example. Dairy, same thing, where we are either slaughtering animals at zero value just to stop them from eating, or we're pouring milk out, that sort of thing. We've all seen that, correct? Okay, so time in this becomes a very important resource, because if I have a 300-pound calf and I market feeder cattle, let's say, I've got a lot of time built in there, right? I have if they gain 2 pounds a day, right, I've got 500 pounds worth of time. If I have a 2-year-old bred heifer, or even a 900-pound heifer, right, in theory, if I sell feeder cattle, I want to get out of that 900-pound heifer like at 850 pounds. But if the market goes totally berserk, what could I do? Right, put her with a bull. Now I have like 8 years to get out of her. Does that make sense? Okay. So time is a precious resource. Okay, any of these, if I run myself out of any of these things, and you're welcome to volunteer if you've ever done this. You ever run yourself out of money? Yeah, we all have. It's super expensive, isn't it? It's like the worst interest rate or bank fee charge you can imagine, right? You ever run yourself out of grass? 2 years ago when the drought was really getting cooking, did you get short on grass? Did it cost you a ton of money? If you were trying to buy $240 hay 2 years ago, it cost you a lot of money to run out of feed. And then we talked about running out of time. Livestock, and but again, I'm a little livestock oriented. This is not entirely true. Running out, or I should generalize this. So this is livestock or commodity crops. If we don't have any cows, we have severely limited our profit potential. Okay, we could sell feed as an example. But generally, we've reduced our profit potential, but we haven't necessarily cost ourselves badly. Okay, if I have, let's say I'm a cow guy, and I have a ton of feed in my pastures, I have options. If I'm a cow guy with a ton of cows and no feed, I don't have very many options. Does that make sense? So there are lots of ways in this where you can sort of put your own back up against the wall and make your own situation worse. And then there are other ways where maybe it's not as good as you would like, but your back isn't against the wall. Does that make sense? Debt can do the same thing. There's nothing necessarily wrong with debt. Most of us manage it really badly. We'll talk about that in a little bit. But you can put yourself in a very bad corner by being over leveraged, right? And it forces you to do things that are not the ideal. Anybody been there? Most of us have. Okay, good. Any questions on this? No? All right. Okay, then now we're going to get to the real meat. This is where the scoreboard comes in. You don't drive down the road without occasionally looking at your dashboard, right? If you've got an old ranch truck, the speedometer may not work. That is not ideal. You can get around, you can do it, but it's not a great situation especially if you're somewhere where they're picky about speed limits, right? We want a dashboard that gives us the most actionable information with the least effort possible. Okay, I mentioned at the beginning, I don't do this for the bookkeeping's sake. We do this entirely to get to action. Action comes from a couple of things. It comes because things are timely. It becomes because things are reasonably accurate. And it comes because we have confidence in the outcome. It's a huge movement in the world of accounting to move towards like AI, data entry and that sort of thing, okay? It will improve, but right now, as an example, AI data entry is absolute garbage. Most of you that manage your own financials do it very badly. Okay, so as a result, with either of those systems, when you do it very badly and then you see the outcome, what's your first thought? Pardon? Yeah, that may be. Do you act based on financials that you don't trust?
No.
Usually not. If you do, special gift to you, that may work, it may not. But most of the time when people look at their own financials, they don't trust the result, right? And that means you don't act. If you don't act in a dynamic market, you have a problem. There's a funny guy down in Wheatland who likes to talk about ranching at the speed of commerce. And what he means by that is you have to be able to make decisions in a timely way. I have a friend who does some consulting. We met kind of on through some professional stuff. Great guy, really like the stuff he does. He says that it takes him 3 years to get accurate financials for a ranch. Okay, that's great, but you tell me what the price of hay 3 years ago tells me about what I should do the next 60 days. Yeah. Absolutely nothing. That's exactly right. That's like worse than nothing, because it's not just I don't have information, I have information that's bad, right? I might derive a false sense of confidence from the fact that I actually know what's going on. And that's a bigger problem than actually admitting I have no idea what's going on. I'm entirely guessing. Accuracy in my mind that is actionable is not precision. When most people get into bookkeeping, I'm going to pick a little on accountants. They're very picky about what's got to be in the right category. It's got to be the right amount. Everything's got to match to the penny. To be actionable, it doesn't have to be that. We do accounting in such a way so that it does match to the penny, right? You got to get to that for other reasons. But precision is one thing. Accuracy is another. My numbers I'm going to say my personal numbers are always wrong. I know that. Right? The gross margins I have on stockers are wrong by a significant percentage, 10 to 25%. I'm more than willing to concede. But they give me a direction. And the direction is not north or south. They're not 180 degrees wrong, right? It might be north versus north-northeast. I'm in the ballpark. This is a hand grenades game, right? If I get it close, it's going to work, right? This is not a sniper game. Right, this is a shotgun game. We're trying to get in the ballpark of correct. And if we get past that, we do two things. We slow everything down, and our opportunity to be really meaningfully wrong, to miss the target entirely, goes way up. Does that make sense? So when we are bookkeeping for a ranch, yeah, it matters what category it goes in, but what really matters is that we understand how things relate to each other. Does that make sense? Relationships become the most important thing, both interpersonal relationships and relationships between things. Take that cow-calf versus heifer thing, or the replacement heifer versus the heifer-calf. If I just say, look, I know I can go sell a replacement heifer for $1,500, if I'm off by $70 or $100, still doesn't change the fact that there's not enough margin in that thing for me to go buy $1,100 heifers and turn them into replacement heifers. And my profit goal on that usually is like $500 in addition, right? So I'm not looking to like make it by this much. I want to shoot a gap this big. If it's there, I'm good. I've got enough to cover the fact that I'm not very good at the details. Does that make sense? I'll just tell you, in our company, I am not an accountant, not a real accountant. I just play one on TV. I have real accountants that work for us. We have this wonderful back and forth of what's good enough versus what do we need to know. There are two types of personalities in the world of finances, and I don't mean this anyway by a degree standpoint, but since we're at a college, there are basically CPAs and there are MBAs, and they don't work well together. The whole purpose of our company is to mash those two together almost as violently as we can, right, to get the best individual outcome for our customers, okay? If you work with a CPA that is a real tax person, an incredibly good CPA, they probably don't know anything about business. And if you work with an MBA, they probably don't know anything about accounting, right? So somehow we have to get to this point where we can kind of do both, because that's what works best for the people that run businesses, right? It's nice to have an MBA who can tell you from 30,000 feet about strategy and all the theory of business, right? Most of the time that doesn't work out any better than just having the CPA run the business, right? When the CPA is in charge, you're in trouble. When the MBA is in charge, you're in trouble. You have to be able to do both to be effective. All right, and again, all of our financials start at the end. What do we want to know? And that drives not only how we structure the data, but also how we enter the data. Does that make sense? So we almost are always working backwards, and data and quality of data entry matters. If you have an accounting system that is too confusing and stuff winds up in different categories and nobody really knows what it means, you're spending a lot of time, effort, and energy to do something that's completely worthless. If you look on the web and search under chart of accounts for agriculture, you'll come up with some great stuff from Texas A&M that lists like 5,000 different accounts that you can import into QuickBooks that will allow you to do the accounting for your ranch business. I'm going to tell you that I hate that system. Our goal is like 45 accounts. I have a good friend that likes to say that customers are confused when they have 250 accounts in their chart of accounts. They are less confused, although still mildly so, when they're only 45. We try to keep this as simple and as operational as possible. We work on direct costs that are very simple, big categories: vet, feed, brand inspections, commissions, freight, that sort of thing. We then work with overhead categories that are pretty general. Is it an admin expense like insurance, right? Or is it a labor expense? Is it a land expense? Or is it PPE as an accounting term for property, plant, and equipment? Is it fuel? Is it repairs and maintenance? Is it tires? However you want to do those things. I know people that break all of these categories into like 50 different categories underneath them, right? We've all seen QuickBooks that it's like it's a $100,000 a year business and it's 4 pages of P&L. It's absolutely useless. You can't do anything with it because you can't see it, right? It's just too spread out. You have to be some sort of savant who can keep numbers in your head while you're flipping back and forth through pages. I can't do that. We keep it as simple as we can. So we have 4 main overhead categories: admin, labor, land, PPE. We use kind of an abided P&L where we keep taxes and interest and agricultural program payments out of the main operating business because we want to look at the business separate from those things first. And then we keep a pretty simple balance sheet with current assets and fixed assets, liabilities, that sort of thing. This, by the way, is all available on our website. I'll give you the address at the end, but it's ranchrightllc.com. You can download this if you want to play with it. Any questions about this?
Run that out there again, ranch what?
ranchrightllc.com, right as in right hand. There's like a resources page, and there are a bunch of downloads.
So you spread that out over, what's that, about 8, 10 columns? That's for, I guess we would all have special categories for one reason or another. So, you might add.
That's what everybody thinks. If you become our customer, you don't have special categories.
No special categories for you.
There are some slight modifications on here. So take the asset and liabilities as a good example, right? Everybody's got a different number of loans. You have to put those in specifically. You can't generalize those. But if you tell me that you want a special category for a special type of fertilizer, I'm gonna push back and say I've never seen tracking that really make much difference. Now, we do track different things by enterprise, and I'll show you that on the next slide. So if you have a hay enterprise and a cow-calf enterprise, we do those entirely separately, and never the two shall meet, okay? That's important.
Quick question. So
Yeah.
if you wanted to track what income was the most profitable, say you had multiple revenue streams.
Yep.
I don't see that reflected on there.
Correct, it's not here. So let's talk about 2 things. Let me just go to the next slide. Okay, there are two ways we do this. The list down the left-hand side is reflective of our chart of accounts. Okay, those are the expense categories that we put things into. What's a little hard to see at the top, because it's blocked off a little bit, is that each column is a separate enterprise. So the first column is a cow-calf enterprise, the second column is a stocker enterprise, the third is a replacement heifer enterprise. Okay, so we do keep track of those things differently.
So if you do QuickBooks Online, you use tags to do that?
No, we are using classes. Great
Classes,
question.
yes.
And then we are very careful about,
So if you're
this is
running
also
two-
available.
So I have an
online.
LLC with a DBA and I have tags, but you could have columns with different tags.
Correct.
So you keep it all.
Yep, you have to pay for a different QuickBooks subscription to
Of
do
course,
that.
yeah.
It costs $85, not $35. So yeah, sorry, that's. But that gives you the ability to look at different enterprises. And even within this, we are fairly general with our classes or with our different enterprises, the columns. We are very specific about the items that we sell. And we track those in QuickBooks so that we can generate a sales by product report, right? I can see what percentage of my income is coming from bred cows, what section of it is coming from steers, heifers, cull cows, cull bulls, replacement bulls, you know, lambs, keep on going. Does that make sense? So the goal is to get a 30,000, okay, let's back up. Goal of the P&L is to get kind of a, I'm even gonna call it a 20,000 foot view, right? We wanna see where the main action in the business is happening, okay? But we don't necessarily get into all the detail. If we do our record keeping correctly, then in QuickBooks Online and in QuickBooks Desktop, I can click on any one of these numbers and get all the drill down, okay? And what most people try to do is they want all the drill down right here, okay? And that doesn't work, right? So we have, the data integrity underneath this is very important, okay? And so that, boy, this number, and I don't, I was hoping for a pointer too. Is there a pointer?
There is.
Where do you
It's the
push?
top button.
Oh, it is there. Huh.
It might not show.
Except you can't see it on the screen.
Yeah.
That's awesome. Oh, yeah, you can. There it is. All right, so let's just take feed as an example. This number seems like, boy, that's some trouble right there. Or even better, this number is some trouble, right? Okay, I can click on that number and it's gonna give me a lot of detail, okay? We use a P&L and a balance sheet for a quick, you know, sort of a quick, I'm gonna call it the 20,000, not the 30,000 foot snapshot, okay? But then we have the ability to keep drilling down. All right, does that answer your question? All right, great. Is this a format that's familiar to most people? If I show this to you as a P&L, does this kind of make sense? Anybody completely lost? All right, great. So we've got our chart of accounts down the left-hand side here, and then we've got each of our, it's hard to see, each of our enterprises in a column. Now, the way we set this up, this first part, I want to pay attention to what's called a trading account. I want to know when we are looking at our income, whether or not we are selling the factory or we are growing it. In a crop enterprise, this is less important, but still relevant. I want to know, are we going into our inventory and living off of past production, or are we living off current production? The trading account, I think I have a slide for this. I'm gonna have to go back and forth just a little bit. Is basically, or our gross profit is our gross product minus our direct costs. The gross product becomes very important in this scenario. That is the total trading account line in our type of P&L, where we take our opening inventory and our closing inventory, and we look at the difference between those, right? Opening inventory is a negative in our current year P&L. Closing inventory is a positive. And then we take our revenue and our purchases and then any transfers in and out of that enterprise that are kind of within company transfers, right? So if I take my heifer calves from my cow-calf enterprise to my replacement heifer enterprise, I just track that value from one enterprise to the other. Does that make sense? The trading account and the gross product is the total value of everything you produce, whether you sell it or not. I've had people that come to us and they say, oh my goodness, we're in a crisis. Our business has fallen apart. And we get to asking some more questions. They say, well, we decided to sell direct-to-consumer beef. Well, what is that? If they were a cow-calf producer, what does that usually mean? Yeah, they literally didn't sell stuff, right? And they've kept it. That creates a huge cash flow challenge, but it doesn't mean your business is a disaster, right? They still have value in the business, they just didn't sell it, okay? The whole problem with the IRS and the way that we do most accounting in this country is whether you're a cash or an accrual basis tax filer is their version of accrual is really pretty pathetic. Accrual means you have to add the inventory and the cash together. Does that make sense? When we talk about accrual, we're often talking about did they cash the check on January 4th or December 31st, right? We're playing that game. That, in my mind, is still cash, right? Real accrual accounting in agriculture means that we are tracking the value of what we produce in addition to what we sell or what we buy. Going into a drought, you will see, and the IRS will see, that your income usually goes up, right? You are destocking, your income's going up. Is that good for your business?
No.
Depends.
Yeah, true.
What if you don't have grass?
Yeah.
Right? Might be a great decision for that year, but it doesn't mean you're actually producing what you were answering, right? You're not like, oh boy, suddenly no, you're selling factory, right? You're giving up future production to save costs in the short term most of the time, right?
Yeah.
On the contrary, let's just say that all of this wonderful winter we've had is leading us out of drought. When you start restocking, your income often goes way down. Is that good or bad? Usually it's good, right? Okay, this will get a little messy at times because a real accounting person will say, well, wait a minute, you're mixing the balance sheet and the P&L. Yes, we are. Is this 100% correct? Not really. There's a firm that got really famous for doing mark-to-market accounting. They're called Enron. They did it really badly. They were dishonest about it. But that is kind of the technical term for what we are doing here. But I always tell people, but not in the Enron way. We're not cheating. We are just trying to make sure that our current production and the value of that production is reflected as we look at our different enterprises. Does that make sense? Anybody know? Do I need to go further on that? Okay.
And you just said,
Yeah.
mixing profit and loss and,
Balance sheet?
the balance sheet.
Yeah.
That's what you would normally not do. In this, it makes sense because you really need that scorecard and to manage the business.
Bingo. Okay, so let's go back. I'm going to talk about the balance sheet here more in a minute. But in the P&Ls that we produce, we focus first and foremost on this gross profit line. If you guys are not familiar with the Ranching for Profit School, it's a great program. They teach this to producers, and they do a really good job of teaching it. We also have some educational materials on our website and on our YouTube channel that talk about this. 80% of the value that we provide to our customers is that line right there. And it comes from putting the financials together with the inventory, okay? Gross profit, as I mentioned a minute ago, is your gross product minus the direct costs. And what this gives us is a very fast way to evaluate each of these enterprises without involving all of the intricacies of worrying about the overheads, okay? Gross profit is the money that is left over after direct costs to pay your overheads, to service debt, and to create a real profit in the business. Let me say that differently. To pay your overheads, to create profit, and then out of that profit you can choose to service debt or put it in your pocket. Does that fit? Or grow your business. Does that make sense? When I look at, boy, should I run more cows or should I run more stockers, I can do some incredibly complex scenario analyses that take a long time because, of course, if I run more cows, then my land cost per cow changes, right? You have to, my machinery cost per cow changes. There are a whole bunch of things. If I know roughly how much it costs me to feed that cow, and feed is often one of our biggest costs, right? So land, labor, feed are the three primary costs in most ag enterprises. If I know what the feed cost is per cow, and I look at running more cows, I can come up with a pretty good estimate of what the total impact on the business is going to be without ever looking at the overheads. Because the overheads probably aren't going to change. I'm not going to have to buy a new pickup in order to run 20 more cows, right? I'm not going to have to buy another tractor to buy 20 more cows. Now, if I run 500 more cows, I may need another guy, another pickup, and another tractor, okay? So imagine we're staying kind of within these stepwise transitions. But with this number, I can quickly say, and I'm just gonna walk through some math. I've got another sheet, we're gonna do it. But just look at the relative number of the gross profit line and the total income line for each of those enterprises. Okay, the first, what do you notice first? If I compare my replacement heifers, my stockers, and my cow-calf enterprise, what do you notice first?
I can't see the screen.
Can't see the screen. There's one behind you too, if that helps. I'll read them off to you. The gross profit on the replacement heifer enterprise is negative $3,000. The gross profit on the stocker enterprise is $65,000. And the gross profit on the cow-calf enterprise is I'm just gonna call it $160,000. What's the first thing that should jump out at you? Negative 3,000. How much is that replacement heifer enterprise contributing to paying overheads or creating profit? Zilch. It's taking it away, right? Most ranch businesses are comprised, farm or ranch businesses are comprised of 3 to 5 different enterprises. Almost always there's a dog, and almost always there's a thoroughbred. Okay? The best thing you can do is cut the throat of the dog. Get out of that. Unless there's some, and I love dogs, please don't take that. But we've all had that dog that you would be better off without, right? One good dog's worth 2 in the saddle, right? One bad dog takes away 3, right? So this is the first thing that you almost always notice. I am spending a lot of time, effort, money, etc., doing something that returns 0. Unless there's some reason you can come up with that says, I can turn this around in a way that is, truly, it is unrecognizable to what it is now, just stop doing it. It's like the easiest thing you could possibly do,
What
right?
is a byproduct, but other than that, you're just,
Great question. Go a little further.
so I have a chick hatchery.
Okay.
And I sell baby chicks.
Yes.
Pullets, everyone wants a female, right?
Yes.
They lay eggs. I have the roosters that I raise up for meat birds. They're my lowest performing enterprise or revenue stream.
Okay.
Because they take a lot more feed and labor.
Yep.
You have to wait and you have to process them.
Yep.
Now, they still have a little bit of profit, but not near as much as just selling it as a hatching egg for someone else to hatch into a baby chick.
Yep.
So whereas
Yeah.
cut the throat of all the roosters?
Right.
Chicks?
Great question. Okay, so first off, let's clarify a definition. I'm gonna say that roosters aren't actually a separate enterprise unless you make them one. Because can you have a chicken business and have no roosters?
No.
Okay, so bit of a problem
But you
there.
could kill them right away once they're identified, once they're sexed.
Absolutely. Okay, so within that can you have a cow-calf business without having bull calves? Like, you can, but it's hard. There's a huge resistance there, let's just say. So then you get into within the enterprise, then choosing what to do to generate the most value from that, right? Again, it's the same principle. Sometimes it's easier to just quit early than to chase it all the way through. A place where most businesses that I see that succeed the most, they turn that very underperforming part of the business into something that either performs a lot better or they figure out how to get rid of it. So and again, just imagine you have all these roosters. I mean, if you just gave them away to someone, you might be better off than actually running it all the way through. Now, you said they do generate a small profit. If it doesn't take away from your ability to do your main business, then I'm okay with that. But there's this point where even a small profit isn't worth it, right?
Yeah.
Where you could say, right, it's taking time away from me doing what I'm really good at and what generates a lot of profit. So again, find a teenager, hand them boxes of roosters and just walk
Nobody
away.
wants roosters.
Yeah, well, I understand.
Pet
I
store
don't
for
want 'em.
snakes.
What'd you say?
Pet store for snakes.
I've tested the pet food market, and it's just not in Wyoming. You have to be in a bigger urban.
Yeah, Colorado would be
Yeah,
there.
front
Yeah.
range.
Yep. So does that answer your question?
Yeah.
Okay, once we get into this, there is a lot of nuance, and I'm kind of, we're doing a quick 90-minute overview. So, and it's a very good question. Let me give you another one. We often have pastures that have weeds in them, right? The weeds are a cost. They're part of the cost of managing that land. If you can turn that weed into goat feed and then actually sell a profitable goat, you've not only eliminated a cost, you've added another profit center. You've done yourself double better. Does that make sense? Now, I know people that have gone out and bought 1,000 goats and every single one of them died. Not necessarily much better off, right? Would have been better to just spray the weeds. But there are lots of places where if you can turn something like that into something completely different, it's worth doing. And if you can't, then you're probably worth jettisoning it early. If you tell me that I am going to hit you in the nose as hard as I can, I am not going to tell you to come tomorrow and we'll do that. I'm going to say, let's just do that now, get it over with. The anticipation is the worst part, right? Spending 100 days to get to a not very valuable rooster is the worst possible outcome, right? Okay, you have a question?
So on this example with your replacement heifers,
Yes.
when you've got something like that, obviously you have to have replacement heifers unless you're gonna go buy, you know, short-term cows or something like that.
Mhm.
So when you have something like that, that yes, they are costing you money, but to go buy them outright, if you're raising your own versus going to buy them, to get that quality, you know, that's a trade-off there. You probably are gonna spend more to get that quality.
You might.
So how do you kind of balance that and keep that in consideration of when it's like, well, maybe this year we better sell extra, you know,
Yep.
kind of a deal?
Yeah, great question. And I'm gonna, if it's all right, I'm gonna defer that. Because there are, I'm just gonna tell you, we got this data set, we licensed this data set with Ranching for Profit. They use this for a teaching deal in their school. There's some serious flaws in the data. I'm not gonna claim any, you know, it's a good demo of the fact that enterprises are different. There are ways to get through the replacement process, if you will, that are not as bad as what some people do for replacement efforts. I'll just take the example. At one point I lived in southern Wyoming. Because we were at 7,000 feet, we sent all of our heifers to Torrington to be developed and bred. It would cost us, you know, for a while it was costing $300, and then about 2012 it cost $700, right? It was a case where our replacement heifer deal was a complete loser. We didn't stop running cows, like we were able to keep running cows, but we never did that again. Does that make sense? Okay. There are a lot of options in this world.
Yeah.
One of my favorite things on that is to go buy a 10-year-old cow for cull cow price who is pregnant, keep her heifer calf, right? And then suddenly I basically, you know, pay for the cull cow, like with the heifer herself. I then cut the head off the cow. Now I have the replacement heifer. I can go a different direction with that. Nothing against Torrington, Riverton. You guys feed cattle too. You know, when you come from southern Wyoming, it's very attractive to ship them somewhere else. Sometimes that pays, sometimes it doesn't. Any other questions or comments? No? Good. Okay, so the other thing you can do here that's pretty easy is you can divide the gross, make sure I do this right so the number comes out right. Divide the gross product by the gross profit and come up with something we call a gross profit percentage. You can refer to it as like an enterprise efficiency, okay? So if I take in the first column on our cow-calf enterprise, we have $232,000 and we have $158,000. And I'm sorry, the other way, we divide the 158 by the 232. I want a number that is less than 1. Okay, so if you get it and it's greater than 1, we need to undo it. But we have gross product minus cost, so the gross profit number should be smaller or equal to the gross product number. What's 158 divided by 232? Anybody got a calculator real quickly? I should know this number right. Let's go. Okay, write that number down if you got a pencil. You have a pencil, yes, 0.68. Take the stalker number, do the same thing. What's 65,000 divided by 86,000?
0.755.
Okay, in theory, I could run the stalkers or the cows on the same grass. In Wyoming, we don't have the Florida problem where, you know, you have big grass that stalkers can't eat, and you have, right, so any class of animal could eat about the same feed resource. In that particular case, when I compare those two enterprises, my investment in that stalker enterprise returns me 75 cents for every dollar I put in, and my cow-calf enterprise produces 68 cents. I'm gonna claim those two numbers aren't that different in the real world, so I'm not gonna sweat that. In some cases, one will be like 30 cents on the dollar, and the other will be 80 cents on the dollar, right? We're looking there for big differences. You can't even calculate the number, because if I divide that, you know, when the number's negative, we know it's bad just to start, right? We don't have to go any further. The other thing we do is we take these overhead categories, so admin, land, labor, and PPE, and I generally leave admin out. I don't have a good index for that. But I divide the gross profit number by the total land costs, by the total equipment costs, and the total labor costs. I'm going to show you that again in a little more detail in a minute, but you can see, you can do the math in your head, right? Kind of. So our gross profit here is, let's just call that $260,000. Is that fair? Okay. And if you can't see the numbers, just have to trust me, I'm probably not lying. Okay, my land cost is $60,000 in this example. if I divide 260 by 60, what do I get? 4 and...
4.3.
Yeah, great. That means that for every dollar I'm spending on land, I'm getting back $4.20. Okay, we can think of this number as a ratio and we can talk in fractions. Fractions don't mean much to me. What it means is how many dollars do I put down and how many do I get back? Take our labor number. What's 260 divided by 175?
1.48.
Okay, I'm gonna tell you that's a terrible number. For every dollar I spend in labor, I get $1.48 back. That's a very, very bad number. Does that make sense? It's not enough return for me to then pay taxes and, you know, risk major truck repairs and all that kind of stuff to have that additional unit of labor. Does that make sense? Okay, we'll talk about these a little more specifically in a minute. And then the same number on equipment. This is my favorite one on this example. You've made $260,000 in gross profit. You spent 225, let's call it, on equipment. What's that number?
115.
Okay, is that worth it? Probably not, right? Just the risk alone in owning equipment is not worth 15 cents, right? We got to produce a much bigger gross profit to make spending that much money on equipment worthwhile. Does this kind of make sense? Okay, when we look later, I'm going to come back to this number, but see this net operating income line? Okay, this is the performance of our business before interest, taxes, depreciation, and is that right? Interest, taxes, depreciation. What am I missing? Yeah, okay, good. Thank you. Amortization. That is the number, particularly in our world, that we use. 2 years ago, 3 years ago, there was a lot of COVID money in the world. We put that at the bottom so that it showed on the net income line down here, but we put it as an other income type of income because we wanted to look at the business without that. Doesn't mean you can't pay your bills with that, that's fine, but we want to know what the difference is, right? So if you're doing a grazing CRP program or you've got a bunch of equip projects, that sort of thing, we're gonna pull those out of the business. They're still gonna be reported, right? They still matter to the bank and everybody else, but I'm gonna tell you that that's probably not why you're in business. Most people aren't in business so that they can collect PRF insurance, right? They want to be in the business to make money from their production, right? From their management, from their investment. All right, we're gonna run through quickly this. Okay, so this is a balance sheet as we use it. This is more complex than I want it to be for this presentation. I need to make another copy of this. But you understand balance sheets, I hope. We have assets and we have liabilities. Our assets include current assets, which are things that are reasonably liquid, let's say, right? So money in the bank would be a current asset. Stocker cattle, broiler chickens, eggs, all these things, those are current type assets. And then we have fixed assets. Fixed assets in our world include breeding stock, so ewes, cows, and machinery and equipment. One thing I didn't mention at the beginning of this, we work very hard to separate the land business from the operating business. And so you will see on a lot of our stuff, I mentioned 3 biggest costs, right? Land, labor, feed. We do the land as a separate business entirely. The performance of the land business is so vastly different in both structure and kind from an operating business that we do that as one analysis, if you will. We do the operating company as another. Even if the operating company is fundamentally the one paying the debt, when you submit your balance sheet to the bank, you're going to push the 2 of them back together, but we look at them
So
separately.
do you separate, do you recommend, let me put it that way, do you recommend separate entities for that, like holding companies and
It depends. Generally, yes. Generally, we recommend that the land is held either individually or like by a simple LLC, and then the operating company leases from either the individual or the LLC. And whether you do that just on paper or through actual entities is kind of up to the specifics of the situation. There are plenty of cases. I don't want to encourage anyone to run down the entity road because there are plenty of cases where it's just not worth it.
Well, there's a lot of cost too.
Correct, it adds cost without necessarily adding value. I'll just say that once you get to the point where you're producing, say, $60,000 to $100,000 in real profit from that business, then you need to get serious about entities.
Okay,
that
that's a
work?
good, that's a good threshold.
That's where the tax advantages overcome the extra cost. Yes?
It also, like, my family that farms in Iowa, the land is under an LLC because of all the family members.
Right.
Correct, you can
Whereas
have
my
different
land,
parties.
I have it under my personal name and my LLC paid rent. So
Yeah.
there's, depending on the family
Right.
setup or transition.
Yeah, that makes
stuff like
sense.
that.
Don't let your lawyer talk you into all of this stuff because of risk protection, because then what happens is most people get talked into that by a lawyer and then they do everything out of one checking account.
All of
You're
the
cooked.
checking accounts.
So, yeah, or 17 checking accounts all going to, yeah, good. This should not be a lawyer-driven process, this should not be an accountant-driven process. This has to be like a real process that has a little bit of input from all of them. Those people are advisors, they are not the owners. It's a whole different topic. I actually enjoy the topic of entities and all that, but it gets down a different road. Okay, and then we break assets into current and long-term, we'll call them, which is what fixed asset means the long-term asset. And, you know, some banks like to break this into intermediate and long-term. We just do long-term. You know, a pickup truck, a cow, a set of corrals, those are all long-term assets we don't worry about. I'm interested in the next 12 months, and then I'm interested in the future. And that's all we care about. Frankly, we really care about the next 12 months. Then we have long-term assets, right? This could be your mortgage, long-term liabilities. This could be your mortgage if we were blending these things, which I told you I didn't like to do, and then there's a mortgage on there. This could be a livestock loan, right? Like a 5-year term loan. This could be equipment loans, that sort of thing. But we are really focused in our deal on the numbers that are total current assets and total current liabilities. We'll get to that in a minute. And then we're interested in the total fixed assets and the total long-term liabilities. Okay, so then this should be multiple slides, and I apologize, I did not break this out. So then here's what we do for our simple summary, which I will claim will solve 99% of your business problems. We look at the gross margin percentage for each enterprise. So in this is a different ranch, I should tell you. This is the gross margin percentage, right? So the gross profit divided by the gross product for each enterprise, okay? So this is the efficiency of our capital within that enterprise. If we assume that all enterprises are independent, there's no sort of complementarity between them, we could just use that number very easily to compare. Usually that isn't exactly the case, right? There's some advantage to having the sheep with the cows, right? So it's not quite a pure deal, but we can think of it that way. This is a particularly well-performing business in my mind. He runs sheep. His gross margin or gross profit percentage is 92%. That means for every dollar invested in that business, right, or brought into that business through the creation of value or through actual sales, he gets to keep 92 cents of it. 92 cents gets to go to cover his overheads, create profit, service debt, pay taxes, all that stuff. Does that make sense? Okay. In this particular business, my goal generally on a ranch type business, not a feedlot as an example, is 70% or above. So when we have a customer with those numbers, we mark those cells green. Okay, green is go, yellow is caution, red is stop. The idea here is if it's green, you probably want to keep doing it. Now he has some opportunities where everything is green, so we're going to want to slice that better, right? Would you rather keep 74 cents or would you rather keep 92 cents? Well, you'd rather keep 92, right? But the dog deal is kind of a spin-off. These are guard dogs we're talking about. The guard dog deal is kind of a spin-off of the ewe and lamb enterprise. So he's not really giving anything up by...
Have you ever tried to, so I have a guard dog for chickens.
Yeah.
They eat a lot of food.
Yeah.
But they protect a lot as well.
Right.
Have you ever tried to value what they're,
Oh, yeah.
chickens aren't being eaten by coyotes because they're
Right.
there, or the coyote.
Yeah,
They're prey, if you look at it just by the cost standpoint.
That's exactly right. It's a great question. We do all of that outside of QuickBooks. It's usually a simpler analysis. Take the total food bill, take the savings on chickens. Is it bigger? Is it not? Right? And then have some margin. And then you have to put your own stomach into the deal, right? Can I stand showing up and having dead chickens? Am I willing to make an extra $20 but have more dead chickens? It's a great question. Sheep deal is the same way. We look at that a lot. Yes?
Is your 70% benchmark based off like industry standards or your top performance?
It's a great question. It is, I don't know that I truly want to confess what our benchmarks are based off of, because it's kind of like, we just look at it and see how we think. There are some people that have developed formal benchmarks, and 70% lines up fairly well with a formal benchmark that comes from things like SPA and Ranching for Profit used to do this. I think it's a good question, and I'm just going to tell you it's not as formal as you think, because when we get into the world of feedlots and feed-intensive industries, we drop that number down to 30 to 50%. Just because there's no way in the world that you're going to feed animals and have as high a margin. It's just not possible. I'm also going to tell you that there are a ton of trade-offs in this deal. So what I'm really interested in at the end, and I should always start with this, is this ROE number, right? What is the return on equity that I've got out of this business? This is a totally goofy example because his equity is negative. I don't want to go into that. It's a problem, but it's not a crisis. But if you take his return on assets, it's still very good, okay? That's the number we're really after. Sometimes you will have particular, so you mentioned there are specifics to your business. I would argue this is where that comes up. You might have high land rent and low labor. What matters is how they kind of add together in the end. When we see a problem, we start looking at them in thin slices. When I see somebody with 116% return on assets, we don't get into a lot of the details because there's a bunch of stuff that's clearly working. Does that make sense? Okay, so a lot of these are a little more based on, not our top performers per se, but our like top 20%, okay, or top 25%. We have numbers for each of our top performers, which we compare these to. And what's interesting is, like I say, every business has specifics. Our top performers overall, as measured by growth of their balance sheet, right, driven by net income, not by asset appreciation, but their growth on their balance sheet driven by net income is huge, and their land number is high, and it's or low. Their land cost is high, if you will. Again, we're not going to fuss too much about that because you've got so many other things going for you. Okay, all of these things are very interrelated. Does everybody understand the gross profit percentage? Does that make sense? Okay. This is a rare case to look at, 6 enterprises, 5 enterprises where they're all pretty good. Like I say, almost always there's a dog. First thing you can do is slice the throat of the dog, you'll be better off. All right, the next thing we look at is turnover. What is our capital doing for us? So we have I mentioned the inventory value. We have a huge investment most of the time in animals and in crop production expense, right? What is that doing for us? I really like Robert Kiyosaki's discussion about assets. If you know about him, you know that to him, his definition of an asset is something that produces cash flow. Your banker thinks that everything you own is an asset. That in our world is a bad way to think about it, right? I want my assets to be things that generate income. A cow in my business is an asset. A tractor is an expense. I don't get anything out of the tractor. And you can say, but tractors have gone up the last couple of years. No, we're not having that discussion. Not true. They have gone up, but the replacement has also gone up, right? So that's where that comes in. So the real asset base that drives our income, we want to know what the performance of that is. If you have a sheep enterprise where you own $61,000 worth of sheep and you create $295,000 worth of value, I'm very excited for you. That's a great return, okay? Our benchmarks here are fuzzier. They depend a little on how we do the valuation. Any number over 100 is a number I'm usually excited about. Depending on the business and depending on the scenario, there are times when over 80% is good. These numbers I'm showing you, I need to come up with one that's got more variance in it. These are the clean ones. When we get into things like custom grazing, this number isn't very helpful because there's no underlying asset base, right? So you can just sort of ignore those huge percentages. They're almost just like errors. But the overall performance of this business is that he's receiving 185% return on his total assets invested. How many of you are doing that? Just out of curiosity. Anybody feel like they're almost doubling their money every year? Okay, well, challenge accepted, you say. You're underperforming. What do you gotta do to get there? This kid's done some pretty innovative stuff, and he's had a little bit of luck. Markets have worked his way, but he's been very smart about it. This has been very intentional. We're gonna look at these overhead ratios. I mentioned this, the dollars generated per overhead category. This is a good example. His labor return is not that good. You asked about averages. Our top 20% are doing $8.50 to $11. Our best individual performance in labor is doing over 40. Every dollar he spends on labor, he makes 40. If this number goes to 2, you're in trouble. If you are expanding, we talked about stepwise changes in our overhead costs. Right when you get to that step and you jump up, you may go back to 2, but you better be building it back from there. I prefer if you're at 8.50 to 11 and you drop back to 4 and then go up. Employees are expensive, they come with a lot of risk. You know, I am a total believer that, you know, employees, well, I should say I'm a partial believer of the statement employees are assets. Employees can be assets. We've all had employees that are assets. We've all had employees that are liabilities, right? The 8.50 to 11 people have employees that are assets, right? And they have a business that is designed to make the most of those assets. Yes?
On labor costs, this is like kind of spoiled, but
Yeah.
how do you include kind of paying yourself? Or how do you factor
Right.
that in? Because otherwise you might look like you're making a bunch of money, but if you're not taking out $30,000 a year to live off of, like, you're screwing yourself, really.
Totally agree. And we add in an opportunity labor cost.
Okay.
Same if you own the land and you're not paying yourself rent, we put it in.
Okay.
We can debate what that number should be. Should it be 30,000 or should it be 80,000? You know, I'm good if you have some number in there,
Yeah.
okay? But your business should be paying your labor. I get it if you're starting from scratch and you're too small to get there. It probably isn't gonna pay you an $80,000 full-time salary. It's probably not a full-time job. You may have another job. So you can sort of, you know, you can do a sweat equity investment to get going. But if you're 40 years into this business and you are trying to make it full-time and you're still not paying yourself, you've got a problem. We do not pay ourselves out of profits. Profits are not to go on vacation. Profits are not to pay yourself, unless it's a distribution. We can talk more about that. Profits are for growing the business, servicing debt, and then generating a real profit, which is what you do after those things. Yeah, distribution, if you will. All right, any questions about those numbers? His number on labor is relatively low. You can imagine why a lot of sheep businesses have a lot of labor. It's kind of the nature of the beast. If you want to reduce labor, you run cows, takes fewer people, you don't have to shoot coyotes, there's a whole bunch of stuff that goes with that.
Dogs.
Well, and we add dogs into the labor. Horses, dogs, barn cats all go into labor in our system. Any questions about this? Great. Final things that this is the place where, again, I don't know how relevant this is to you guys, but working capital and debt coverage ratios are hugely important. These are things that make or break you. Working capital is simply your current assets minus your current liabilities divided by your daily cost of operating the ranch. So we take all of your expenses, add them together for a year, divide by 365, and then we divide your working capital number by that. Working capital, when you are short of it, you don't sleep very well. You are constantly worried. You're worried 12 months of the year. Debt coverage, if you don't make enough income to pay your debts, you don't sleep well for like 4 months of the year. Does that make sense? We're not going to go into great detail on this, but these are two numbers that are critically important. If you are out of whack on either of these numbers, you are severely limiting your business. This is like driving the boat with the anchor down. This is a huge drag because it adds a lot of expense, takes away a lot of opportunity, takes away a lot of flexibility. Questions about this? All right, this is kind of detailed, I know. I don't know any other way to go through it. I'm not going to go through that. Let's go to questions. All right, so hang on one second. Let me go back to this. These numbers come, and I'm not going to show you where, but they come straight off the balance sheet and the P&L. These numbers, I can produce this spreadsheet for one of our customers in under 5 minutes. This is super easy to do. And this gives us, like I say, 99% of what we need to know to diagnose where the big problems are. If you have a gross margin problem, we start there. Either eliminate the enterprise or make it better. And acceptable is sort of this bubble thing where it's like, oh, it's acceptable, but it's not great. Can we make it better, or where are we at risk-wise with that? Then we look especially at this asset turnover ratio and the overhead ratios to make sure that, again, there aren't other flaws in our business. Lots of us have overhead problems. Many people try to solve their business by cutting their overheads. Once you're to reasonable, there's no additional benefit from doing that. You're better off to focus on gross product, right? On producing more value for customers. And then keeping yourself out of trouble in the world of debt and having a real idea of when you can add more debt and when you should be getting rid of it is a very, very important piece of our equation. We service debt with cash, with profit generated by the business, right? When that profit gets to a certain size, we can add more debt comfortably. If we don't have enough profit to service the debt, then we're not sleeping and we're fighting with our spouse and we're not getting renewed at the bank and we have all kinds of other problems. All right, great. Any questions, thoughts, comments? Sorry, I used more of my time than I thought I was going to. This ends at noon, right? Sorry, I'm late. Yes?
Y'all find we use common size P&L scale compared to like 5 million versus like $500,000? Do y'all do that at all?
It's a great question. We do some of that, but it turns out it's, other than some of these overhead ratios, it's not as meaningful as you would think. If you're driving really strong gross margins, you can have a very small business and make it work. But it does matter. There are some things that come with large business that are actually handicaps. Everyone that's small says, all the big guys have all the advantages. Everybody that's big says all little guys have the advantages. They kind of turn out to be a wash a lot of the time. One of the things that you see in a lot of big businesses, is that there's not a theoretical labor cost, there's a real labor cost. And sometimes they have to pay workman's comp where other people don't. There's some things like that. Or even health insurance benefits now, right? But generally, like I say, a high-performing business that's generating 20 million a year versus one that's generating 100,000, the characteristics are very similar. They're not weighed down by debt, and they have great gross margins. And their overheads are reasonable.
Do you find the need to break up your benchmark by direct-to-consumer versus big branches as well?
Yes, we have a different, and I apologize, I didn't bring direct-to-consumer benchmarks, but we have different benchmarks for those. Yeah, again, very similar process. The numbers are literally different. And a big part of the direct consumer business, as I'm sure you can imagine, is time. It takes a long time. If you're a grass to plate type deal, it takes a long time in the cattle industry. It takes a long time in the sheep business, right? The chicken thing, I think you have some advantage, right? The turnover is naturally higher because they're littler. But as you go to bigger and bigger animals, that time becomes more and more important. We do those, when we do the divisions on those, we incorporate a time correction, so we annualize them to compare to like a stocker business, for example. So if you tell me you've got a 30% return, but it takes you 30 months to get there, I'm not impressed. You tell me you have a 30% return in 100 days, now we're excited, right? So a lot of that is time. Does that answer your question? Great. Anything else? Yes?
So you started out with saying if you're in the stalker business, if that is your jam, so to speak,
Yeah.
and going direct to consumer, not the best idea. What if you're direct consumer going into the stalker business, or want to add that as a funnel?
Great example. Maybe. It depends. Do you know how to care for cattle? Right? I know people that are very good at, they buy finished animals, they slaughter them, sell them to customers. They have no idea how to go catch one out in the pasture if it's sick. So again, it's play to your strengths in this. Do what you do and do it really well.
In our case, a daughter came home and she wanted a place on the farm.
Bingo.
And the marketing thing.
Yep. Yep. But that's her thing, right?
That's her thing.
Right. And this is a great way to grow the business, is to bring someone else in that can do that part, right? My plate's already full. Most of us don't just have a lot of free time, right? If you work in agriculture, you'll probably fill your days somehow, right? Adding a whole nother enterprise is difficult. It's a great way to expand when you're bringing kids home. but it can also be a great way to get yourself into a ton of trouble. Again, I use the example of people that know that they should be running sheep on their sagebrush ranges. They add sheep or they add goats, and it's a complete flop because they literally don't know what they're doing. It's a lot of fun to manage a Peruvian herder when you speak no Spanish. Other questions or thoughts?
A lot of material there. I mean, it was a fire hose.
Sorry, it's a little dense, yes.
Not bad, it's great. How do we, are we taking this? Oh, okay.
Cool.
Can watch it again, we can get a reaction.
That's perfect. We have a website where most of the stuff I put up, like if you're a bookkeeper, that chart of accounts deal is on our website. We do a monthly webinar for our clients, and it's kind of open to the public. We record it live. You're welcome to join us live on there, or it's also on YouTube under Ranch Right LLC. You can look that up. We spend most of our time focused on pretty basic financial concepts. So that started with, let's walk through a balance sheet. What does it mean? Walk through, I didn't show the DuPont model here, but how do you evaluate some of the critical parameters on your balance sheet? What do you do with your P&L? You know, what does that info mean? We find that our goal is to provide actionable financials to our clients. What we have found, of course, is that is not enough. We have to then teach them how to use it. Because if I give you 5 pages of financials and say, hey, here it is, you got the best of the best, I don't know how to read the first page. Like, yeah, okay, I get it. Right. So that's sort of the other half of our business, is really teaching people how to do that. We've actually started a separate education company, which is ranching.fyi. I should have put that up here. We have a bunch of stuff on there too that ranges from sort of production type stuff to also some financial stuff. Great, sorry, I'm over time.
All right.
Okay.
Help me thank Mr. Haskell.
Thank you very much.